Think about the last time you sat down at your kitchen table after payday and pulled up your bank account. You watched that direct deposit hit. You felt that brief moment of relief, then you started doing the math: rent, groceries, car payment, insurance, subscription you forgot to cancel, the minimum payment on that credit card you swore you'd pay off this month, and somewhere between the deposit and the math, the money just disappeared. You didn't splurge. You didn't go out. You made coffee at home. You did everything the advice columns told you to do, yet somehow, you're right back where you started. Maybe even further behind. You sit there in the quiet, and that familiar feeling creeps in. The one that whispers you're bad with money. That if you were just more disciplined, more responsible, smarter about this, you'd be fine. But here's the thing. That feeling? It's not an accident. And the struggle you're in? It wasn't designed to be easy to escape. Here's what most people don't realize. The system isn't neutral. It was never built to help you get ahead. It was built to keep you in motion without ever building momentum. Let me be clear about something. Every financial product you interact with, your credit card, your car loan, your employer benefits, even the apps on your phone, they're all designed with one core principle: make spending frictionless and saving nearly impossible. According to research from Cornell University, when consumers use one-click checkout services, they increase their spending by 36% and shop 43% more frequently. 8 seconds to spend $500. But opening a high-yield savings account? 20 minutes, identity verification, 3-day waiting period. The game isn't rigged because you're failing. You're struggling because the game was rigged from the start. Consider the debt products marketed as responsible choices. The average credit card APR in America is now 22.3% for accounts that carry a balance. If you have a $6,715 balance and pay $150 a month, you'll spend over 8 years paying it off, and hand over $8,054 in interest. That's more than double what you originally borrowed. The system profits when you stay earning, spending, and starting over. Month after month, year after year, and it goes deeper than that. Let's start with the products you were told were normal. Responsible, even. Credit cards aren't designed to be paid off. Car loans aren't structured for your benefit. Payment plans exist to maximize the interest you pay over time, not to help you afford something. Here's the mechanism most people never see. When you make a minimum payment on a credit card, almost none of it touches your actual debt. Take a $2,000 balance at 22% APR. Your minimum payment is typically around 2% of the balance, so $40. Sounds reasonable, right? Here's the twist. Of that $40, roughly $36 goes straight to interest. $4, actually reduces what you owe. At that rate, you're not paying down debt. You're renting it, and the system knows this. According to the Consumer Financial Protection Bureau, about 1 in 10 cardholders still make only the minimum payment. That's millions of people locked into years of payments by design. Now think about someone financing a $5,000 used car. Responsible decision. They didn't buy new, they shopped smart. But the loan was structured at 18% interest over 5 years. By the time they own that car, they've paid $8,000. They handed the lender $3,000 in interest for a vehicle that depreciated the moment they drove it home. The implication for you? The system makes going into debt easier than saving because lenders profit from your perpetual payments. The longer you pay, the more they make. It's not a bug, it's the entire business model. But that's only one part of how the system keeps you in place. Now let's talk about what keeps you from leaving even when you know you should. Your benefits aren't just perks. They're handcuffs. Employer-tied health insurance, retirement matching, vesting schedules, these aren't designed for your security. They're designed to reduce your negotiating power and keep labor costs predictable. Here's how it works. Research from the U.S. Government Accountability Office found that workers with employer-provided health insurance are about 23% less likely to change jobs compared to workers with alternative coverage. That's not loyalty. That's fear. You can't leave for a better opportunity without risking your family's health care. You can't walk away from a toxic environment without forfeiting unvested retirement contributions. The system makes staying the only rational choice, even when staying costs you more in the long run. Consider someone working a job they hate. Toxic manager, stagnant pay, no growth. But they're 2 years into a 4-year vesting schedule on $20,000 in employer stock contributions. If they leave now, they lose half. So they stay. 18 more months of burnout, missed opportunities at companies willing to pay more, deteriorating mental health, all because the cost of leaving is too high. According to a Yale Law Journal analysis, vesting schedules lead to billions of dollars in forfeited funds each year. Money workers thought was part of their compensation package, gone because they needed to leave before the arbitrary clock ran out. What does this mean for you? Your employer benefits aren't just about healthcare and retirement. They're about making it expensive for you to leave. And when you can't leave, you can't negotiate. And there's one more layer to this you need to see. You now see why you've been stuck. What comes next is the part that changes how you move through the system. The architecture of money tells you everything you need to know. Spending is frictionless. Saving is built like a fortress. Research from Cornell University found that when customers use one-click checkout, they increase their spending by 36% and shop 43% more frequently. You can buy a $500 item in 8 seconds on your phone. Tap. Face ID. Done. Now try to open a high-yield savings account. You need a driver's license or passport. Social security number. Proof of address. Contact information. You fill out forms. You verify your identity. Some accounts require minimum deposits. You wait 3 days for the transfer to clear before you can actually use the account. The process takes 15 to 20 minutes if you have everything ready. And that's if you don't get stuck in the verification loop. Here's the part that makes it clear this isn't an accident. According to banking industry research, nearly half of consumers, 48%, abandon digital account opening when they encounter friction. One extra verification step and people quit. The banks know this. The retailers know this. They engineer the path of least resistance to point exactly where they profit. Buy now, pay later hit $45.2 billion in the US in 2023. The average user took out 6.3 loans that year. Why? Because it's embedded right at checkout. No application, no waiting, just split your payment into 4 and keep shopping. Meanwhile, moving money into a savings account requires logging in, navigating menus, confirming transfers, waiting for processing. One path is a freeway. The other is an obstacle course. And it's designed that way because companies profit from the velocity of your spending, not from you holding cash. The implication? Your environment is engineered to make the wealth-draining choice the default. Every single time. So what do you actually do with all of this? Here's exactly what to do. Not theory. Steps. First, automate wealth building before you see the money. Set up direct deposit to split your paycheck the day it hits. 10% to savings, 5% to a separate high-yield account if you can. The rest to checking. Make saving the default so spending requires a transfer. Friction works both ways. Use it. Second, add intentional friction to spending. Delete saved payment info from every retail site. Turn off one-click purchasing. Unsubscribe from promotional emails. Make buying require effort. If it takes 8 seconds to spend $500, make it take 8 minutes. That pause is where you take back control. Third, audit your debt for the forever payment trap. Pull up every loan and credit card. Calculate the total interest you'll pay if you keep making minimum payments. Then prioritize killing the highest interest debt first, even if it means slowing other goals. You can't build wealth while renting your own money back at 22%. Fourth, calculate your employer handcuff cost. Add up what you'd lose if you left tomorrow: unvested stock, healthcare transition costs, unused PTO. Know the exact number. Because once you know what staying costs, you can negotiate from a position of clarity or plan an exit on your terms. This isn't about blame. It's about seeing the board clearly so you can finally play to win. If this breakdown helped you see what's been hidden, you'll want to watch how the tax code is designed to favor wealth over work next. Subscribe so you keep getting the system breakdowns the banks don't want you to see.